Hello, and thanks for joining us. Our company began over 11 years ago. My name is Corrine Fitzwilliams. My husband Timothy and I started this business, and we have been doing workshops and dinner seminars for over 8 years at places like the Butcher's Son, Harper's Table, Aberdeen Barn, and La Yaca, just to name a few. In that time, we've seen hurricanes, blizzards, and we've even had the entire block lose power, and we finished our seminar by flashlights so guests could enjoy their dessert. Why? Because we believe in education. That's simple. Each of our families have been affected by poor retirement planning. Often, when you seek advice, you're given a piece of a puzzle, and that works for the moment, but when you retire, often the puzzle pieces that you've gathered don't fit together. Our goal is simply to help folks look at the pieces that have been gathered and help them solve the puzzle while making sure they don't lose any pieces in the process. We treat everyone that we meet the way we would like our own family to be treated. Now, I will be going over some important information today as it pertains to COVID-19 and the economy, but I just wanted to share with you why we do what we do and a little bit about who we are. Fitzwilliams Financial is a full-service firm. I'd like to give you a piece of advice I wish my own mom had received when she was in your shoes. Please do your research, whether it's someone looking at your roof or your finances. Make sure they align with what it is you need. Google them. Go to the second and third page. Visit LinkedIn, visit Facebook, look at their Google reviews. And I'd like you also to check out our website for more information, or just call and get to know us. Have a chat. We love getting to know people. We're all here today because, among other things that obviously have us concerned, we're nervous about the markets. So I'd like to spend the next 20 minutes together giving you some key insights, some concrete questions you can ask yourselves, and some practical action steps that can be taken to increase your financial certainty. Because whether you're sitting in front of your TV, your computer, or whether you're scrolling through your phone, uncertainty seems to rule the day right now. Monday, on March 9th, marked the beginning of the stock market crash of 2020, with the history's largest point plunge in the Dow Jones to date. That day was followed by two more huge drops on March 12th and March 16th. And so far, we have seen the three worst single-day drops in U.S. history. Over just a few weeks, the markets have dropped anywhere from 25 to 30%. And the question everyone is asking is, should I stay or should I go? In other words, should I ride this thing out as many advisors have traditionally recommended, or should I stand to lose a ton more waiting for things to bounce back? If that's you, if you're wondering what to do, I want to let you know that at the conclusion of this session, you'll have the opportunity to set up a 15-minute phone consultation or a virtual meeting with our team, and I highly encourage you to do that. We've been flooded with individuals calling for advice over the past couple of weeks, and that's what we're here to do. We're happy to assess your situation, talk through your options, and help you come up with a plan to ensure that you protect yourself no matter what happens in the markets. So be sure to take advantage of that opportunity when we wrap up today. It's really no wonder you're concerned about the market. If you asked 5 people right now what the market's going to do, you would get 5 completely different answers, because the truth is, no one really knows what's going to happen. And frankly, anyone telling you that they can predict things should seem eerily suspicious right now. We are in uncharted waters here, and there has never been a global pandemic impacting the markets such as we're experiencing today, and no one can predict where things will go from here. So with so much information flying at you at once, how do you even make sense of it all? And knowing that no one has a crystal ball, what indicators should you be looking for right now to help inform your decisions? Well, there actually are some key indicators that we can keep in front of us for perspective. Let's take a look. Here are 5 key factors to keep in mind as you consider your financial future and the level of risk you're willing to take. First, the speed with which the market has dropped. Second, the potential for that market to drop even further. Third, the skyrocketing unemployment numbers we continue to hear about. Fourth, the overall impact this pandemic is having on several key industries and the economy overall. And finally, the rate at which this virus continues to spread. Now, let's take a look at each of these individually. The first variable that we can look at is the speed with which the markets have recently declined. It only took the S&P 500 22 trading days to fall 30% from its record high reached on February 19th, making it the fastest drop of this magnitude in history. If we take a look at this graph showing data from Bank of America Securities, we can see that the second, third, and fourth quickest drop on Wall Street occurred during the Great Depression era in 1934, 31, and 29. In other words, nothing like this has ever happened, but the closest thing to it was nearly a century ago, during the worst economic downturn in our country's history, when the market crashed in October of 1929. By July of 1932, the Dow Jones was down 89% from its previous record high. So as you think about your retirement savings, it becomes critical to consider a second factor. How much further could the markets continue to drop? Having seen a roughly 30% drop so far, and knowing we don't have the virus even remotely controlled yet, it's fair to at least acknowledge that the markets could still drop considerably more. In fact, in a March 23rd article in Forbes Online, senior contributor Chuck Jones indicated that it was very plausible the market could drop another 20 to 40%. Again, none of us knows what the market is actually going to do, but hypothetically speaking, if the market did drop just another 20%, bringing the total decline to 50%, let's look at what it would take to recover. Things many people misunderstand is the amount of gain required to recover from a loss. Mathematically speaking, losses hurt a lot more than gains help. As an example, if you had $1 million in the market and lost 50%, you would be down to $500,000, right? And many people simply think, well, if I had a 50% loss, I obviously need a 50% gain and I'll be back to where I started. Unfortunately, that's not how the math works out. And this is one of the most commonly misunderstood things about the market. As you see here, if you took the $500,000 you had left after the 50% loss and you experienced a 50% gain, what would you really have? You'd actually only be getting back $750,000, still well short of the million that you began with. In reality, in order to recover from a 50% loss, you actually need a 100% gain. And how likely is that to happen in the market? Better yet, how long might that take? During the Great Depression, when the S&P dropped 89%, it took the Dow over 25 years to return to its previous high. So, while we don't mean to be alarmists, if you were to experience anything even remotely similar, you'd really have to ask yourself, do I have the time necessary to even see the markets climb back up? For someone 60 to 70 years old, they simply may not have that many years. Several of you may recognize this man. He's Warren Buffett, one of the most famous investors alive, and he's currently the 4th wealthiest individual in the world. Everyone in our office knows him because he was one of my husband's college teachers. He's known for his market savvy. Warren Buffett has amassed a net worth of $70.5 billion. And what does he have to say about incurring market loss? Well, he's been quoted as saying two primary investment rules, which our company actually took on as our company motto. Rule number one, never lose money. And rule number two, never forget rule number one. Why does he say that? Because, as we've seen, losses hurt more than gains help, and it takes a lot to recover from a significant loss. Buffett always understood that if you want to make money, you start by not losing what you have. He also recently said, "It's insane to risk what you have for something you don't need." In other words, the fourth wealthiest man on the planet isn't a big fan of taking on excess risk, particularly when it's not required to reach your end goal. What does that mean to you? It means if you can live the life you've desired in retirement right now without having to take on significant market risks to hopefully accumulate more, you likely should. For many of you, you've had a good run in the market over the past decade, and if staying in right now to hopefully pick up some gains if the market recovers would be nice, but it's not necessary, the added risk just doesn't make much sense. So having looked at the speed of the market dropping and how much further it could potentially go, let's look at our third factor to consider. The third indicator is the alarming rate of unemployment being caused by the virtual shutdown of our nation. A record-breaking 3.3 million Americans applied for it the week ending March 21st. The previous unemployment record in this country was just under 700,000 claims, filed in a single week back in October of 1982. That means the week ending March 21st was nearly 5 times higher than the previous record. Forecasts for unemployment continue to rise. From 500,000 to 5 million new Americans could be without jobs. In fact, weekly unemployment claim numbers are climbing so rapidly that the White House reportedly asked state officials to delay releasing precise counts. Economists at the Federal Reserve project total unemployment could reach 32.1%, totaling 47 million Americans. 47 million people. That's roughly equivalent to all the residents in New York, Florida, and Colorado combined. So unemployment doesn't look good. What about the global economy? Well, our fourth variable here is the impact this outbreak is having on major industries and the economy worldwide. The retail industry, which is normally responsible for contributing $2.6 trillion, or about 25% to the annual GDP, has nearly ground to a halt with store closings. The hospitality industry is losing roughly $1.4 billion a week with travel restrictions now in place globally. According to Reuters, global airlines estimate their 2020 revenue losses at over $250 billion as planes sit idly at gates everywhere. All told, estimates suggest the coronavirus could easily cost the global economy over $2.7 trillion. And what does all of this truly mean? Well, first, it virtually guarantees continued market volatility for months to come. Second, it means additional economic stimulus will likely be required by the government, which could lead to higher taxes in the future as we all have to help repay the funds used. But all of this could greatly be improved if we just stemmed the tide of the corona outbreak itself, right? So how are we doing there? Let's take a look. The U.S. now has the highest number of known COVID-19 cases in the world, quickly surpassing China and Italy. There are currently over 93,000 Americans suffering from it, and those numbers, by many accounts, are surely very conservative, as people in many states struggle to even be checked for it due to the shortfall of tests. Epidemiologists at the University of Washington predict that if gaps in healthcare resources aren't filled, more than 80,000 Americans could die by July. To put that in perspective, let's look at the counts in the U.S. from recent outbreaks such as SARS and H1N1. SARS claimed 774 lives worldwide, but none in our country. In 2009, H1N1 killed 12,496 people in the U.S. So the death toll in just the next few months is anticipated to be 6.5 times worse than the 2009 H1N1. So with all of these variables considered, and so much feeling completely unpredictable right now, what can we predict? What can we be sure of as it relates to your financial future? In reality, the only thing that's certain right now is uncertainty. And while we'd like to know when this pandemic will end and when everything will return to normal, the truth is we likely need to be planning for the worst and hoping for the best. What does that mean? Tactily, to you, right now, about your retirement savings? Well, there are obviously hundreds of things that you could do with your money in this environment, but just for the sake of this discussion, let's focus on 3. The first option you have with any money currently invested in the market is to simply leave it alone. Just about everyone has heard the phrase, ride it out, or been told just weather the storm, and for decades, many advisors have been advising their clients not to time the market, but to leave it in for the long haul. The problem is, as we've discussed, there is no current assurance that A, we're at the bottom of this present decline, or B, that we're going to see any noteworthy recovery anytime soon. And again, if the market was to drop another 20 to 40% on top of the 30% it's already fallen, you could find yourself 60% down from where you began. If you had even $1 million invested in retirement on March 8th of this year, that would leave you with just about $400,000 right now. Many people just aren't interested in that kind of risk. Option number 2 is to simply sell off or cash out and hang on to what you have left. For many people who've been invested over the past decade, you're still sitting on some solid gains over that stretch, and you could decide you simply want to cash out and completely sit on the sidelines while this entire ordeal sorts itself out. While you'd be obviously earning nothing on your money, you might subscribe to the old saying that a bird in the hand is worth 2 in the bush. However, knowing at some point in the future the economy will start to recover, do you really want to miss out on all of the potential gains of riding the market back up? Many people aren't interested in that plan either. So if staying in the market doesn't make sense to you, but going completely to cash and earning nothing when the market recovers has no appeal, then what are you supposed to do? Well, everyone's situation is unique and calls for custom-tailored solutions, which we can help you with. But I can tell you one benefit many people are looking for, and that's found in option 3. So let's take a look. A powerful third option for those that don't want to ride things out and don't want to just go to cash might be the use of a fixed indexed annuity or FIA. FIAs are retirement savings vehicles that provide complete principal protection, meaning that the money that you put into them can never be lost to market downturns. And they also give you the opportunity for growth. Just like a traditional fixed annuity, an FIA is an insurance product often intended for retirement income purposes. However, unlike traditional fixed annuities, a fixed indexed annuity gets its name because it's tied its annual growth to a market index, such as the NASDAQ or S&P 500. Rather than offering a set or fixed interest rate, an FIA's interest credits follow the performance of the market index to which it's tied. Because principal is protected in an FIA, should the market index go down in a given year, your account balance remains flat or unscathed for that year, and you simply receive zero interest. Should the market rise, you get to participate in a portion of those earnings. Now, you can't have your cake and eat it too. So an FIA will not provide you all of the earnings of a rising market. Your earnings will be capped at a certain level and also be subject to spreads and early withdrawal charges. But that's the simple trade-off for knowing that your money, which you put into an FIA, will never be at risk again. It might help to understand an FIA by thinking of it like this. You sit down at a blackjack table and the dealer says, all right, here's the deal. At my table, if you lose a hand, I just shuffle the deck and re-deal. No chips lost. But if you win a hand, I keep 50% of the take. If a dealer told you that, you'd probably sit at the table all night. Who wouldn't, right? Because while you're not promised the moon and stars, remember, the dealer's keeping half of your earnings, you're promised to never lose a dime. In other words, it's all upside possibility with no downside risk. This is very much like the premise of an FIA. And let me tell you, right now, people with money in fixed indexed annuities would be doing cartwheels if they could, because while their neighbors and coworkers and family members might be 30% down in the market, their account balances are simply remaining flat. They're not losing a cent. If you're wondering if an FIA might be right for you, simply ask yourself this question. Which would you rather miss out on? Capturing every cent of an eventual market recovery when this pandemic ends, or potentially losing 20 to 40%? If you're okay with missing out on some of the future recovery, but you can't stand the thought of more loss, then it's more likely time to hop on the phone with us. None of us know what lies ahead, but the Chief Investment Officer of Guggenheim Investments just said in his recent CIO Outlook, I'm not betting on a global depression, but I'm saying that for the first time in the post-war era, we are really getting too close for comfort. When the CIO of a global investment firm managing over $270 billion says something like this, you want to listen. The road ahead is likely to be bumpy, and while tons of things right now are out of your control, your financial future actually isn't one of them. That, fortunately, is something we can help you with. In the midst of these crazy times, it's important that you not just have a portfolio, that you have a plan, and we can help. Getting started with us is simple. While businesses all over the country might be shut down, ours is 100% open, and a visit with us is very easy. It can be an initial 15-minute phone call or a virtual meeting over the computer with our team, or if you want to put on your mask and gloves, you can even visit us in the office. You just click the link to choose your desired time, and we'll reach out to you. Now, here's what your first meeting with us won't be. It won't be one of our team members sitting on the other line trying to pitch you something or telling you to grab your checkbook. What it will be is us trying to get to know you, asking you key questions, listening to your concerns, and we conduct a risk exposure analysis, showing you exactly how much of your assets are currently exposed to further risk. And if you're interested, we make recommendations as to what your next steps should be to benefit you the most. It all starts with simply selecting a time to connect. I want to leave you with one of my husband's favorite Warren Buffett quotes. And that is, you never know who's swimming naked until the tide goes out. In other words, many people don't realize just how exposed they are on Wall Street until the market crashes. And the good news is, you can do something about further losses right now. Click the link below, choose a time for us to connect, and you'll immediately receive a confirmation email letting you know that we're all set. Then In the meantime, grab a cup of coffee, take a deep breath, and enjoy the little things around you. It's going to be okay. We look forward to talking to you soon. To learn more about Fitzwilliams Financial, visit www.ffinancial.net. God bless.